If the housing market crashes, most people are going to panic. They're going to open Zillow, social media, look at the news, and you're going to see one headline after the other. And inevitably, you're going to ask yourself the same question. Should I wait or should I get out? If you clicked on this video because that question is sitting in the back of your mind, you're in the right place. But what I want to do in this video is slow everything down. Because if you understand how real estate actually works, a housing market crash does not mean pain. It could become actually one of the biggest financial opportunities of your lifetime. So in this video, I'm going to walk you through who actually wins in a housing crash, who unfortunately consistently loses, and how to position yourself before the headlines start changing their tone. And if you stay with me until the end, I'll give you a simple framework you can use to elevate any market. Crash, boom, or everything in the middle, the boring stuff, without having to guess or rely on predictions. But first, we need to clear something up. It's one big misunderstanding that almost everyone has about housing crashes. Most people think housing crashes destroy wealth. They don't. Crashes transfer wealth. It's really important to understand that. When prices are rising, the market's very forgiving. It covers your mistakes. It can take bad deals and make them look pretty good. And what happens is we start believing things like real estate always goes up in value. I'll just refi it later. Or worst case, I'll just sell it. And for a while, that thinking could be justified. But when prices stop rising, the market stops being so nice. And it's going to start asking harder questions. Can I hold this property if rents flatten? Can I make the payment if I can't refi? Or can I survive if my appreciation is completely wiped out? Now look, crashes don't randomly hurt people. They just expose the weakness. So let's talk about 2008. Not the headlines, the actual mechanics. The problem in 2008 was not the real estate market itself. It's not that it was broken. The problem was how people bought. A lot of people bought homes that they could only afford if rates stayed low and prices kept going up and nothing went wrong. So when prices dipped, not collapsed, dipped, they didn't have options. They weren't choosing to sell. They had to sell. They were forced sellers. This was the foreclosure wave. At the same time, there was a small group of people watching quietly. They had income, they had liquidity, that's important to know, and they were patient. They weren't panicking, they waited. And when forced sellers showed up, what did they do? They bought assets at a crazy discount. Not because they were smart, it was really because they were prepared. Same exact market, two completely different outcomes. So what's the lesson? This is what most people miss. The market doesn't reward optimism, it doesn't reward pessimism, it rewards preparation. And preparation has nothing to do with predicting the future. It has everything to do with structure. And that leads to the second mistake most people make when they think about crashes. Most people obsess over prices. How low will prices go? Should I wait another 6 months? What if I buy too early? Those are emotional questions. They're not strategic. And what we want to do is start acting like professionals because they act differently. They care more about financing, downside protection, and flexibility because prices are only one variable. So let me show you what that actually means, and let's use some numbers here. Option one, you wait for the crash. You're the smart one trying to time it. Prices go down 15%. Let's say you're going to buy a duplex for $340,000 instead of the $400,000 before the crash. But now you're in a frozen market. So rates are going to be 8%. Sellers aren't budging on terms, and you need 25% down because lending's tight. You have to remember that. So let's say your payment is going to be $2,500 a month. Rent, you can get $2,600. So what's your cash flow? $100 per month. And you had to put $85,000 down. Option two, you buy it today, $400K, higher price. But the seller's motivated. So maybe they're going to cover your closing costs, $15,000. They offer you 2-1 rate buy down. And you get a favorable inspection term and 60 days to close. Your payment now, $2,200 per month. Rent, same, $2,600. So your cash flow is $400 per month now. And you only put $80K down, which is less than the first option. So which deal's better? Most people are going to say the first option's better because you bought it at a lower price. But scenario B, option B, cash flows. Cash flow's better. Day one. It required less capital and it gives you $300 per month more in your pocket. So that's $3,600 a year. Over 5 years, that's $18K, which is more than the discount you waited for. So waiting for the perfect price feels smart, but in reality, it often means more competition, fewer options, and worse terms. So here's the reframe that changes everything. You don't win in real estate by timing the bottom. You win by buying assets that still work even if things go wrong. If prices fall, if rates stay higher longer, if the market takes longer to recover. That's the difference right there between speculation and strategy. And if you want help working through this clearly, I'm building out a little mini course right now. So if you want me to send it to you once it's ready, just leave it in the comments. I want the mini course and I will send it to you. Completely free, and I'm not going to ask for your information to give it to you. So let's take a boring deal. You buy a single family rental for $280,000. So your monthly rent, $2,100. Mortgage plus taxes plus insurance, $1,700. Let's consider maintenance reserves, $150 per month. Vacancy reserves, $100 per month. Your actual cash flow, $150 per month. It's not exciting. Super boring. But here's what makes it strong. If rents drop 10%, you still break even. If your mortgage rate resets higher, you still break even. If the property says vacant for 1 month, you're covered. If the market crashes 20%, you can hold without panic because the deal wasn't dependent on appreciation. Compare that to an exciting deal, something you're hyped on. Let's say you buy a condo for $350K. Monthly rent, $2,200. Mortgage plus HOA plus taxes plus insurance, $2,150. Your cash flow, $50 per month. On paper, it works, but what happens if HOA does their thing? They increase $75 per month. And they do what they always do. Special assessment, $3,000. Or the tenant leaves and it sits vacant for 45 days. Now you're negative cash flow, $200, $300 per month, and you're stuck. The boring deal gave you 7 different ways to survive problems. The exciting deal, 0. You don't notice that difference in good times. The important thing is, in bad times you do. That's why crashes don't create bad investments. They just reveal them. So here's the truth that applies to every cycle. If you can't hold a property through uncertainty, you don't actually own it. The market does. Because crashes don't punish ownership. They punish leverage with no discipline. And this is why the best opportunities almost never feel good in the moment. I mean, think about it. When markets feel safe, everyone's confident. We feel good. We got money and we feel smart. Everyone thinks they're early, even though they're actually late. That's when the competition is intense. That's when the margin shrinks. And that's when people start saying things like, I'll just make it work. Now compare that to when markets feel uncomfortable. That's right now, 100%. When headlines are negative, when people hesitate, when confidence kind of disappears and there's suddenly fewer buyers, sellers become flexible and information actually starts to matter again. Because unfortunately, we confuse discomfort with risk. Discomfort is uncertainty. Risk is not understanding what you're doing. So if the housing market crashes, the real question is not, will prices fall? The real question is, will you be ready when they do? And being ready means you got to have liquidity. You got to have money set aside to do it. And knowing the difference between a deal that needs to perform and one that can survive uncertainty. So if you want help answering that, make sure you're subscribed to this channel. I'm going to walk you through what numbers you need to elevate before you make any decision, what's going on in the markets, and what to plan for in case things happen. So make sure you're subscribed. Thank you for watching this video. Give it a like. I appreciate you guys on this new channel. I'll see you guys next week.